Good morning, everyone, and thank you for joining us for the ASA Diversified Property Fund and Market Update, our second webinar for 2025. My name is Alex Abel, and I'm one of the managing partners here at ASA. I'm joined by Jonathan Senior and Matt Mitchell for today's call, which we expect will run for about 30 minutes. You can view the recording at a later date by accessing it through our website or referencing the link on your email. Thank you to those who have submitted questions in advance, as we have sought to cover these as part of our presentation. Of course, you can submit questions through the webinar page as well, and if we run out of time, rest assured we will follow up with you directly. Before making any commercial property investment, it's crucial to understand the key forces that shape returns. That is, the broader macro environment and the specific characteristics of the asset class itself. On the left, we have the economic drivers. Think of this as the weather, affecting all asset types. Interest rates, inflation, unemployment, economic growth. These influence buyer sentiment, borrowing costs, and tenant demand across the board. For example, rising interest rates typically lead to higher borrowing costs, which can place downward pressure on many capital-heavy investments, such as property. What we are now seeing is the opposite, with the RBA announcing another 25 basis point cut last week, in addition to the rate cut they made in February. Meanwhile, inflation can either erode returns if rents adjust upward in line with inflation, as they do at some of our assets, it can actually enhance value. Inflation also impacts construction costs, which makes it difficult for new supply and competition to be delivered, potentially resulting in stronger rental growth. On the right side, we have the property lens. Different commercial asset classes respond uniquely to economic conditions. Retail properties, offices, industrial warehouses, self-storage and data centres all have distinct tenant profiles, lease structures and demand drivers. For instance, industrial and logistics spaces have performed really well on the back of e-commerce growth, but there's been a lot of supply delivered in certain markets recently, and as a result, rents are coming under real pressure there. Office spaces are still recalibrating in a post-COVID world, and vacancy does remain elevated at 15% on average across all CBDs. But new supply is also really drying up. And with retail, particularly retail offerings that appeal to cost-conscious consumers, has provided a more resilient income stream over recent years. The best investments happen in the overlap, and this is all about timing to align macro insights with asset-specific opportunities, and we are constantly assessing both layers. We are presenting this on the 27th of May, and to say it's been an eventful 5 months in 2025 would be an understatement. The tariff policies announced on the 2nd of April increased the effective tariff rate in the US from 2.5% to 28%, but by the start of May, that had reduced to 18%, following deals with the UK and China. Whilst the move down from 28% to 18% in isolation was large, as you can see on the chart, the last time tariffs were this high was in the 1930s, when the US economic base was considerably less integrated with the global economy than what it is today. These tariff negotiations continue to evolve as the 90-day deadline approaches on the 9th of July. And as you can see in the second chart, Trump said he would take the stock market on a bumpy ride, and he sure did. The market fell 15% between the 2nd and the 7th of April, and then rebounded by 9% on the 9th of April, when that 90-day pause on tariffs was announced. The volatility has been widespread, whether it's listed equity markets, bond markets, or commodities markets. It's been quite remarkable. But in the DPF portfolio, we've continued to collect the rents, we've paid the distributions, we've finalised multiple new leases and renewals at rents higher than passing levels, and we've also sold a property, and Jonathan will touch on all of these matters. It all seems rather boring compared to the headlines, but it does reinforce the stable nature of commercial real estate investment, especially a portfolio like DPF's that's largely catering to the essential needs of Australian businesses and consumers. Back in Australia, after the very steep rise in the RBA cash rate that started in May 22, cash rates have peaked, and the RBA even discussed a larger cut of 50 basis points at their last meeting in May. Their tone has softened considerably on the back of inflation being below 3% for the first time since 2021, lower growth expectations, and unemployment rising, albeit only at the margins. Expectations of rate cuts have also increased. In February, the market expected rates to be 3.6% by the end of the year, but now they're pricing rates to be 3.35% by the end of the year. Now let's move to some other structural forces that are currently influencing capital allocation decisions. The $41 billion ASX-listed bank hybrid market is being phased out and will end by the end of 2032 at the latest, when the final hybrids mature. This removes a long-standing option for investors seeking tax-preferred, fixed income style returns. Advisor groups and investors that we have spoken to do expect some of this hybrid money, as it matures, to be reinvested into commercial property, as it can provide income with tax benefits in the form of tax-deferred distributions, as well as prospects for capital growth. Naturally, there are alternatives, including term deposits that are lower risk and more appropriate for short-term investment horizons. But the rates on those term deposits are falling as the RBA continues their rate cutting cycle. On the right of the slide, we highlight a growing headwind, but one we also see as a unique opportunity, and that's the impact holding costs are having on foreign investors. The aggressive tax regimes in Victoria and Queensland in particular result in annual holding costs of 6% or more of land value. And this has been really impactful for industrial and logistics assets, which are relatively land rich and face a disproportionate tax burden relative to the income that they can generate. Anecdotally, we've heard of net rental collections being reduced by up to 1/3 due to these taxes. And as a result, we're seeing some early signs of selling from foreign owners, and we do expect that trend to continue. For domestic investors that aren't lugged with these additional taxes, there will be a window of opportunity to acquire high quality assets with less competition, and we expect attractive pricing to emerge in this space. So whilst the macro backdrop remains complex, falling rates, improving confidence, and structural dislocations are creating attractive opportunities. The recent volatility in listed markets has underscored the benefits of unlisted commercial real estate, and we believe the tailwinds are building, making this an excellent time to invest. Thanks for your attention, and I'll now hand over to Jonathan.
Thank you, Alex, and good morning, everyone. Before I move on to the fund update component of my presentation, I thought it'd be worthwhile just to briefly recap on the fundamentals of the ASA Diversified Property Fund as it stands today, both for the benefit of those investors who haven't caught up on things for a little while or aren't on the register currently but contemplating making a new investment into the fund. DPF currently comprises 6 properties of just over $500 million in value. Of these, 5 assets, or approximately 91% by value, are neighbourhood retail or convenience retail assets, with the balance being a fully leased business park just outside of Newcastle. The portfolio's occupancy now sits at 99.9%, and the weighted average lease expiry of 9.8 years is underpinned by blue chip tenants who account for just under 50% of the portfolio's income and include Ampol, Woolworths, Coles, Aldi and Boeing, to name a few. DPF has been around since 2006 and has delivered very strong risk-adjusted returns to its investors, both in absolute terms, having delivered a 10% per annum total return over the last 10 years, and also on a relative basis against its unlisted property fund peer set, and also cash, as you can see on the chart on the screen now. As the end of the financial year fast approaches, the DPF portfolio is now in as good a shape as it ever has been. As I mentioned just now, the portfolio occupancy now sits at 99.9%, the WALE just under 10 years, and our 30+ day tenant arrears are sitting at a mere 0.2% of total annual billings. All of our FY25 leasing renewals are complete, and we've achieved a positive leasing spread of 6%, which is the growth in the new rent over the expiring rent. A great recent addition to the portfolio has been the co-working operator Waterman Workspaces, who commenced trade at Blackburn Square in the last couple of weeks. Waterman has a rapidly growing presence across metropolitan Melbourne and has been very positively received by our community, and really rounds out the compelling service offering of this high-performing retail centre. I'm also pleased to report that despite facing a record 479 mils of rain so far in the month of May, our Williamtown Aerospace asset in the Hunter region in New South Wales has escaped without even a roof leak, and that's really testament to the quality of the assets in this portfolio. Looking ahead out into 2026, we only have 4.5% of our portfolio income expiring next financial year, and we're really well advanced in our planning to ensure that this is secured with a minimum of fuss. This undoubtedly will be assisted by the robust sales that we continue to see in our retail portfolio, and our supermarkets and specialty stores are trading up 10.3% and 26% on an annual basis post the redevelopment of Blackburn and Busselton. Underlying portfolio net rental income growth is tracking a tick over 3% per annum, which over time will ultimately flow through to our property valuations and boost the total returns to investors. We're currently in the process of having all of our assets independently valued ahead of 30 June. In terms of distributions, the board has also recently resolved that the current distribution level of 0.6 cents per unit per month, or 7.2 cents per unit annually, which is a 7.3% yield at the current unit price, will be maintained for FY26. I just want to now touch on sort of some capital management matters, and I'll start by saying several capital management initiatives have been implemented since ASA assumed management of the DPF portfolio in July last year. These have included increased marketing and promotion of the fund to drive equity inflows as best as possible, a secondary market liquidity offer, refinancing the fund's debt, new income initiatives and reinvestment at an asset level to increase property values, the enhancement of the fund's distribution reinvestment plan with an increased discount, and also targeted asset sales. We recently concluded the successful sale of the fund's property in Balcatta, Western Australia, which was settled on the 9th of May in line with our book value. $17 million of the sale proceeds were used to reduce the fund's borrowings. This transaction brings the total value of assets that the fund has sold over the past 24 months to just under $100 million. Now, combined with other movements, fund gearing has shifted down from 50.6% at 31st of December 2024 to around 49% currently, but this still does remain above the upper end of our target gearing range of 35 to 45%. Management and the board does recognise that the timing for recommencement of regular liquidity offerings for investors is an area of particular interest, and is one that we are working to solve as quickly and as prudently as possible. Additional initiatives that we're now sort of actively pursuing include the underwriting of the fund's distribution reinvestment plan, which could potentially bring in a total of $18 million of new equity capital into the fund per annum, a full or partial sell down of assets, and also the introduction of a 5-yearly term liquidity event. The board intends to recommence regular quarterly liquidity when it can do so sustainably in terms of the fund's gearing level, and when it is in the best interest of all fund investors to do so. This is dependent on the time required to implement the initiatives, including those I've just touched on, and prevailing market conditions. With this in mind, at this stage, the board does not expect regular withdrawals to recommence before the 1st of July 2026. A number of investors have recently bought and sold units between each other, and any investor who wishes to register their interest as a potential buyer or potential seller of units should contact us at investorservices@asarep.com or via phone on 1300 556 635 or 613 9909 9909 if you're calling from overseas. Thank you again for your time today and your ongoing support. And I'll now pass over to our Senior Asset Manager, Matt Mitchell.
Thanks, Jonathan. Good morning, everybody. I'll be providing a deep dive into one of the fund's retail assets, Dog Swamp Shopping Centre in Perth. I want to start by discussing the name of the centre. Whenever I'm talking about the asset with someone for the first time, I often receive a strange look and a comment on how unusual the name is. Most centres are named after something appealing like Garden City or something aspirational like Shopping World. And almost all are tied to and named after the community that they serve, like Chadstone, for instance. At first glance, Dog Swamp doesn't appear to fall into any of these categories, when in fact it falls into the latter. The centre is located in the suburb of Yorkine, whose name is derived from the Noongar language and translates to native dog. To the rear of the centre is a large swamp called, you guessed it, the Dog Swamp. So when the centre was constructed in 1967, the name was adopted and has stuck ever since. For what it's worth, I like it. It's distinctive, it's memorable, and reflects the centre's deep links within its community. Now that I've dealt with the name, I'll delve into a bit of the asset's history. As I mentioned, it was built in the 1960s and substantially extended and refurbished by DPF in 2017. Woolworths have occupied the centre for a number of years, and the redevelopment brought in a second anchor in Aldi. In many ways, the centre is now a template for what a good neighbourhood shopping centre should be. It's strongly anchored by 2 supermarkets and has a predominantly non-discretionary specialty offering of 28 shops. The tenancy mix is dominated by fresh food and supported by retail services, a gym and restaurants. We have curated the mix over a number of years to a point where it is now fully leased and has a healthy weighted average lease expiry of 5.5 years. The success of neighbourhood shopping centres is substantially tied to them being perceived by customers to be convenient. Customers want to be able to easily access centres, find an on-grade park without traversing endless multi-stories, and get in to pick up their everyday needs essentials and back out with as little fuss as possible. Dog Swamp ticks these boxes. It is just 4 kilometres north of Perth CBD and is located on a main arterial route into the city. It has easy on-grade parking for 384 cars, and in terms of its demographics, it sits within an established medium density and relatively affluent middle income catchment. For these reasons, the centre has always been a strong performer. Its location in Western Australia has provided the fund with geographical diversification, and its performance has been underpinned by the enduring strength of the WA economy. Through COVID, the centre traded largely without disruption and continued to produce returns when much of the East Coast was locked down or subjected to heavily restricted trading conditions. Beyond the COVID period, the centre has continued to flourish. Total centre sales now sit at just under $90 million. Of these, approximately 69 million are generated by the 2 supermarkets. Woolworths' performance of late has been particularly noteworthy. Their current MAT sales are 50.7 million, up 12% year on year. This reflects per square metre sales of over $15,000, which is exceptional and puts them within range of their percentage rent threshold if their growth trajectory can be maintained. Aldi also performs strongly, and a unique centre aisle offering undoubtedly broadens the appeal of the centre and brings to us a different customer. From a valuation standpoint, the asset currently sits in our book at $56 million, with further growth expected in the coming years. This growth will be fueled by the asset being fully leased and benefiting from fixed or CPI rent review structures in each lease. In addition to its underlying growth, we also look to maximise its net income by actively pursuing asset management opportunities. We've executed a number of these strategies in the past year, a couple of which I want to briefly delve into. Firstly, upon reaching 100% occupancy, we found that we continued to receive inbound tenant inquiries for space. One such approach was from Boba Boba, a Western Australian bubble tea chain. To accommodate their interest, we repurposed 2 external ATM bunkers and an unused service corridor to create a new, unbudgeted shop tenancy, and we then released the ATMs inside the centre. This recently completed mini project generated a net income uplift of $55,000 per annum, and this incremental income, once capitalised, created a valuation gain of $750,000. In turn, this provides unit holders with unit price growth of 1/3 of a cent. Secondly, we have driven supplementary income hard in the last year and realised a net income uplift of $17,180,000. This is for the implementation of recycling facilities, a Bitcoin ATM, skill testers, and vending machine services in the mall. We're currently exploring the creation of a car wash facility in the car park and have a signed offer from a national group to operate it. Finally, we're working on a deal to locate a telecoms antenna at the rear of the centre. Combined, these 2 initiatives have the potential to add a further $80,000 of net income, or in valuation terms, approximately $1.1 million in valuation uplift. With neighbourhood centres such as Dog Swamp, these smaller and sometimes unglamorous initiatives, whilst not easy to execute, can meaningfully boost returns for unit holders if done so correctly. In closing, Dog Swamp sits in a hyper-competitive catchment. Indeed, it shares a car park with a competing centre, Flinders Square. Despite having a very strong Coles, 3 out of the 12 specialties at Flinders are currently vacant, which draws a really stark comparison with Dog Swamp being fully leased and vibrant. The success of the asset is testament to the work done by the fund to redevelop it in 2017 and to finesse its retail mix in the last couple of years. Presentation standards are kept high by the on-site management team, who are constantly seeking outgoings efficiencies. The centre's outstanding fundamentals enable us to continue to grow its income profile for the benefit of unit holders both now and into the future. Thank you for your time, and I'll pass back over to Alex for the Q&A section.
Thanks, Matt, and thanks to you and Jonathan and the whole team for your continued commitment to driving performance out of the assets. That snapshot of Dog Swamp really does give people an indication of where we're really squeezing at the margins to create a lot of value. So I'll now turn to Q&A. One of the first questions we had was, if we were looking in the next 3 financial years from July this year, which of the DPF properties could provide the best capital growth? Probably a bit of a difficult one. It's like naming your favourite children, and it can be somewhat subjective. So I'll give you my answer, and then perhaps Jonathan can comment. So capital growth, it's a function of income and where we can drive that income the furthest, and also the cap rate, which is akin to the multiple that you place on that income. As Jonathan mentioned, the whole portfolio is being revalued at the moment, and whilst it may not come through immediately, I would expect that we do get good growth out of Busselton over the next 3 years as it continues to trade out of the development phase. For those who aren't aware, that completed in late December 23, early 24. So there's a bit of a phased opening there. And the entertainment and leisure precinct will come into its own there. It's already performed really well over the summer there, the first summer that it was fully open for. And we expect that to continue to make it market share and improve. Matt's covered Dog Swamp and the income growth that we're getting out of that particular asset that's really outperforming. And then there's potentially Williamtown. They're really excellent buildings occupied predominantly by Boeing, Lockheed Martin and Raytheon, who service the RAF base next door. There's obviously a strong tailwind with government spending in defence, and there's also a growing residential catchment there as well, heading up into that northern pocket of the Hunter region. So those dynamics bode well as the fact that new supply is really hard to deliver in that market. Construction costs are high, and there's a number of other challenges that new developers may have in putting up competing stocks. So I think that's one to look out for. Jonathan, what's your view?
Oh, thanks, Alex. I mean, I'd largely concur with your comments. The other point that I would make is that this portfolio is really underpinned also by the largest asset that we have in the portfolio, which is the Wyong Twin Service Centres on the Pacific Highway. Those assets have approximately 20 years of lease term to run, and the rent review profile we have there, which is a CPI plus 1% increase per annum with Ampol, really sort of underpins the underlying growth in the portfolio net income. And the other aspect to sort of keep in mind is with 10-year bonds starting to sort of come off a bit, and we think that rates will come off further from this point. There's a likelihood we may start to see some cap rate compression come back into our valuations. And we'll always focus on driving the income growth first and foremost. That's the thing that you can really control the most in terms of providing valuation uplift, but that can be supplemented when cap rates start to tighten up, and I think we're about to start entering that phase. So we think that we can deliver some pretty good risk-adjusted total returns over the medium term for our investors with this portfolio.
Thanks, Jonathan. We've had a question on Dog Swamp and does it have solar panels on the roof? It does. Woolworths actually put those up as part of their renovation and the click and collect that they established there recently. And we're also looking at expanding the solar array that we've got there. Given the amount of solar in the system in WA, there are a number of regulatory hurdles that you kind of need to step through. We've seen this elsewhere in prior experience as well, so it's nothing new, but we're certainly working through the process there because we would love to have more solar on the roof there. We've got another question on retailer administrations. How many have there been in the portfolio, and are we concerned about any particular tenants? I suppose the first one I'll touch on is Mosaic Brands. They were a big administration that happened earlier this year. Their big brands are Miller's, Noni B, Rivers, Katie's, Rockman's, and a number of other brands. They had over 650 stores in Australia and New Zealand, but only one in our portfolio. And that's a credit to Matt and Jonathan. Before they joined ASA, they remixed Bustleton in particular to push a couple of those more dated brands out of that asset. We did have a Rockman's at Bustleton, and we've since released that to Jamaica Blue. Matt was working behind the scenes to have offers in place. We heard that Mosaic Brands were on the rocks. We were looking at the sales figures coming out of Rockman's, so we sensed that there was a bit of an issue there. And more impressively, we've released that store at a rent 30% higher than what Rockman's were previously paying. Other big retailers to fall over this year, unfortunately, has been Jeans West. We didn't have any Jeans West stores, and just in the last week or so, Peter Stevens, big motorcycle group, they've gone under as well. They're a big box retailer, so we're not impacted by any of those. Matt, perhaps you could touch on anything else that I've missed there, and maybe how we manage arrears and sales.
As Jonathan touched on earlier, we're currently in a really good position at only 0.2% of annual billings sitting as aged arrears, which is exceptional for a portfolio of this size and type. The key really to managing it is proactivity. We review arrears weekly. We receive sales reports monthly from all of the shopping centre retailers. The two factors are indelibly linked. Where we see a prolonged downturn in sales, we can often look into the future and see that we will have an arrears issue there. At that point, we will proactively meet with those tenants, have a clear line of dialogue to understand what direction their business is travelling and understand whether it is sustainable or not. Where it isn't, we jump into action and we have our leasing execs start identifying replacement tenants for those spaces. And as Alex touched upon, Jamaica Blue's probably a really good recent example of that, where we identified there was a problem that was getting worse daily, and we approached a number of groups and eventually, in a competitive process, ended up with a signed offer from Jamaica Blue before we had received the notice of disclaim from the administrator. So we're looking forward to having Jamaica Blue opening in the coming weeks, and it'll be a new start for that tenancy and a really good entry statement for what is a really key site at Busselton Central. Thanks.
Thanks, Matt. I'm not sure if it's just my screen, but I can no longer see myself, so apologies if we've got a minor tech issue there. We've got a couple more questions here. We're running hard up against time. I'll answer one quickly and then we'll come back to those investors with those queries directly after the call. Can you explain why Wyong no longer has a McDonald's as a tenant? So what happened there was that Macca's had a lease expiry. Ampol take the head lease over the whole site, so they control both sites over either side of the road. McDonald's had a sublease with Ampol, and they ran a process. McDonald's, I think it's probably fair to say, were a little bit complacent around being able to stay in that site, and Hungry Jack's came in with a really strong offer to come in instead of McDonald's. So that was wrapped up as part of a whole refurbishment of the site. And I personally prefer Macca's, but from what we're seeing out of Ampol's sales, they are still incredibly strong and doing well there, but perhaps not as strong as McDonald's once was. Sorry, I've disappeared from the tech here. Thank you once again for your attention. We look forward to continuing to drive the performance of your investments with us. We thank you for your support, and thanks again, and we'll come back to those couple of questions that we had left over, but enjoy the rest of your day. Thanks again.